Good morning. This is Barry Knapp from Ironsides Macroeconomics, 7:20 a.m. Mountain Time on Monday morning, September 9th. This is inflation and we suppose debate week. Next week will be Fed week. It'll also be travel week for us, Boston and New York. Our note this week was titled Sustainable Disinversion. That's a reference to some of the excitement around the disinversion of the twos, tens curve, but broader issues about the Fed actually delivering on all the expected rate cuts and reconciling that with expected earnings growth in 2025 of 13% for the S&P. So we're struck by that strong earnings growth and expectations for the policy rate at the end of 2025 to be marginally below 3%. Both those two things happening simultaneously seems I don't know, a little bit incongruous at a minimum. So there were four sections to the note this week. We titled the first section Revisionism, which is a reference to negative revisions to the last couple of months for employment. That's been the case 7 of 8 months this year and 11 of 12 last year, which implies that the BLS is systematically overestimating employment growth. Low response rates turn into much weaker growth. Those of you who are looking at the video version of this, you can see our real issue here, which is the blue line from the ADP report that shows just how tepid small business employment is, and our idea that the way the Fed went about the tightening process, passive QT and aggressive rate hikes, put the vast majority of the burden of weaker demand and theoretically at least lower inflation on small businesses rather than large corporates that were able to sell longer term debt and benefit from the Fed's portfolio balance channel also tightening credit spreads. So we then went on to discuss the crumbling foundation, which is the foundation of the labor market, which of course is small business employment. We then went deep into this sustainable disinversion idea, the idea that the 3-month bill 2-year note curve is at its most inverted point in 40 years. So the market has never expected this aggressive of a rate cutting cycle just before the Fed got started. And then finish the note with a section titled Recalibration Reconciliation, which is, again, trying to reconcile those pretty elevated earnings estimates with expectations of an aggressive Fed rate cutting cycle. So we do think that the labor market is decidedly weak. We were not comforted by the bounce back in the work week or a little bit better wage number. Those were just offsets to July. And in fact, the underlying trends here still look decidedly weak when you look through all the labor market data last week, including a big drop in openings in the small business sector. We suspect that the BLS is still overestimating small business employment. If we just extrapolate the first estimate of the benchmark revision through in the year ended March through the next 5 months, we have employment growth at 0.79% year on year. The last 3 times it fell below 1% in 90, 01, and 07, we were either already in recession or just months away from one. And that's entirely possible this go around as well. The unemployment rate didn't really rebound. It was essentially stable if you take it out to 2 decimal places. The U6 underemployment rate ticked up again another 1/10. We think both of those are headed higher. The Beveridge and Phillips curve are at maximum negative convexity, meaning any further weakening in demand would lead to a nonlinear increase in the unemployment rate. That's the real lesson of the SOM rule, which is once the unemployment rate goes up 0.5, it's always gone up at least another 1.5%. That, again, all those things are entirely plausible, and the Fed is going to need to deliver on these rate cuts to disinvert the curve. One way we illustrated that in the note was to show how the ROE for regional banks is a little above 5%, whereas the big banks, the S&P Bank Index ROE is closer to 10. So big banks are doing okay with all of this, but the small banks are really struggling. And the Fed will need to deliver on those rate cuts to improve their profitability. But there are long and variable lags, and the banking system needs those deposit rates to come down. And while this process is taking place, they may very well tighten the credit channel because they get worried about small businesses' ability to pay for loans or repay the loans. And so we don't think that this problem is going to be resolved instantaneously. Market clearly wants a 50 basis point cut. We could see that based on the price action on Friday. We discussed Waller's speech and the implications of that. And if the Fed delivers 25 next week, the markets will likely be disappointed. We don't think the correction's done. Closer to 5,000, we'd be a buyer of the S&P because we do think even if we have a recession, it's likely to be a shallow one, largely because we still have incredibly accommodative fiscal policy. Nonetheless, we're not a buyer of equities at this level. So that's it for me this week. Bearing up from Ironsides. Have a good week, everyone. If you'd like to get a trial to become a full subscriber, please let us know. We're happy to offer a trial. That would come with all our sector and asset allocation recommendations as well. Bearing up from Ironsides. Thanks, everyone. Have a good week.